If you invested $10,000 in Costco stocks 10 years ago, it would have turned into $50,000 today. Costco's stock performance has been great. But will it continue to be great in the future? Last time, we talked about 7 reasons to invest in Costco. Today, we are going to explore 8 reasons to not buy Costco stocks, so you can understand the potential risks of investing in Costco. Number 1. Costco makes you fat. Have you noticed that when you shop at Costco, you typically spend more than you originally planned? You are saving money by buying things in bulk at Costco. But you are likely to consume more than you need when you have items in bigger containers. Research proves that the bigger the package, the more you end up eating. For example, instead of a giant bag of chips at Costco, if you have smaller bags of chips, you would feel guilty if you eat more than one bag. However, if you are holding a giant bag, you wouldn't feel guilty eating half the bag, which might be equal to 2 or 3 small bags. Typically, people overeat ice cream, peanut butter, and cereals sold at Costco. Even the rotisserie chicken is larger than a normal chicken. Costco is engineered to have you consume more and spend more. And younger consumers are noticing that they are spending more at Costco and consuming more food than they need to. Instead of going to Costco once a week, they visit their local stores more often to buy groceries in smaller containers. They understand that this might cost a bit more, but being fat is way more expensive. Number 2. Change in population. In the United States, Costco's median member is around 50 years old. These baby boomers have more money in their pockets and have high incentives to save. In order to continue to thrive, Costco should adapt to the lifestyle of their younger audience. But baby boomers and millennials have different spending habits due to the differences in lifestyle and priorities. For example, baby boomers are likely to own their own homes, while millennials are likely to rent and prioritize flexibility and convenience. Millennials are likely to spend money on dining out and delivery food, while baby boomers tend to cook at home more often. In order to keep up with the change in their customer demographics, Costco must understand and adapt to their younger customers' value. But in reality, Costco is sticking to their traditional business as usual. Number 3. Lack of innovation. Costco's business model is very simple. Sell things at the lowest price possible and earn profits from the membership fees. This has been the way they run business since they opened the first store almost 5 decades ago. It's been working out so far, but will it continue to work in the future? Costco encourages their customers to visit their stores and wander around as long as possible. Costco strategically placed the essential items like eggs, bottled water, and toilet paper at the very back of the store. So you have more chances to discover interesting items on the way. But this kind of business model is not possible during pandemic. Due to global warming, the climates around the world are being violently disrupted. As climate changes and humans have closer contact with wild animals, scientists predict that there will be more virus exposures which may lead to more pandemics. Although Costco's business thrived during last pandemic, it would be wise for Costco management to prepare for possible lockdowns in the future. One of the ways is to build a strong online presence to make up for the offline sales. Currently, about 6% of Costco's revenue comes from their online store. While Costco's offline business model is great, their e-commerce is mundane at best. Costco's online store requires the minimum sales of $75 for a free shipping. And the same item could be more expensive at the online store. I honestly think that Costco doesn't care about their e-commerce business. And that should be a concern for a Costco investor. Number 4. Is Costco's valuation too high? While Costco is settling on their old-school business model, their price-to-earnings ratio is 38.64, which is higher than innovative tech companies like Apple and Microsoft. Typically, tech companies have higher price-to-earnings ratios because their business is more attractive, while retail businesses have lower price-to-earnings ratio because the retail industry is less attractive. To explain this concept in depth, tech companies generates high return on capital employed. Their assets are light as they don't need to build factories. They have high gross margins. Their business is highly scalable and has a high barrier to entry. Many tech companies also have recurring revenue as their customers subscribe to their service. On the other hand, retail business is not a good place to be. Retail stores have low return on capital employed. They are capital intensive as they have to spend billions of dollars for building stores. And they are sensitive to economy as people will shop less during recession. Overall, retail companies are not attractive, and that's why they trade differently than tech companies. As most of net income comes from collecting the membership fees, the only way to grow Costco's business is by opening more stores, which takes time and careful planning. That's why one might argue that Costco stock is highly overpriced. Number 5. Subscription fatigue. These days, we tend to subscribe to everything from music, home entertainment, gym membership, newspaper, and even a car. Although about 93% of existing Costco members renew their membership every year, modern customers are sick and tired of the subscription fees. When economic times are tough, customers are likely to cut these expenses first. As Costco's business model heavily relies on collecting membership fees, decrease in membership could significantly impact their financial health. Number 6. Geopolitical threats. Costco opened their first store in China in 2019 and has been opening more stores. These stores have reportedly been very popular with Chinese consumers. China has a population exceeding 1.4 billion, with the rise of the middle class. Many Chinese consumers are looking for high-quality products at low prices. Costco's CFO, Richard Galanti, said, "We are very pleased with our initial results in China, and we plan to open new stores." However, the tension between the United States and China is higher than ever. Recently, a Chinese spy balloon hovered over U.S. nuclear missile facilities, causing an F-22 to strike it down. Costco, being a company based in the United States, doing business in China could be a potential risk. There is a possibility of the Chinese government and media disrupting Costco's business operation. Such events could limit Costco's growth and negatively affect the share price. Besides, Costco has a significant portion of its stores located in a few key regions, such as California and the Pacific Northwest. Any issues in these regions, such as natural disasters or economic downturns, could impact Costco's overall performance. Number 7. Economic conditions. Costco's financial performance is tied to the overall health of the economy. In a recession or economic downturn, consumers may cut back on discretionary spending, which could impact Costco's sales and profitability. Number 8. Higher labor costs. Costco is known for paying its employees higher wages and offering better benefits than many other retailers. While this can lead to higher employee satisfaction and lower turnover, it also means that labor costs are a significant expense for the company. Any changes to minimum wage laws or other labor regulations could impact Costco's profitability. These were the 8 fundamental reasons why I think Costco is a bad investment. If you have other reasons to invest or not invest in Costco, please share them in the comment section below. This video is meant to help you understand the risks of investing in Costco and save your time researching. Please note that the responsibility of your investment decisions are entirely up to you. If there are other stocks you'd like us to analyze, please let us know in the comment section below.